Hey guys, RC Peck here with Fearless Wealth. And what I want to do is I want to go over a lot of the comments or some of the comments that you have left. And I read every comment you leave. Some of you also email me. So everyone I read, and I just selected a few here. I think about 8 or 9 if I'm right going from memory. So I want to go over those comments. And I want to do kind of want you to hear how I think about what you're asking and how I answer that. Of course, guys, disclaimer, I'm not your advisor. None of this is financial advice. Please, past results are not indicative of future returns. Take your responsibility. I'm not giving individual advice. I'm giving education, and I want you to think of it that way and receive it that way. So disclaimer, disclaimer, disclaimer. With that, let's get to the comments. So here is a comment here from Viswanoff. How do we know big money is shorting a stock from charts? The answer is we don't. Charts show us what the price is doing. What a chart does show us is if shorting is making a difference in that stock, right? Because if you have something, this is Bitcoin right here. If you have something, let's just put something else in. TSLA, let's just put in Tesla. That's not Tesla. That's another company. TSLA. It doesn't show us if the stock is being shorted or not. All a price chart shows us is the price personality, right? And a price can really only do one of three things. It can go up, it can go down, or it can be confused and not know what to do. And clearly for Tesla, it was going sideways for 1, 2, 3, 4, 5, almost 6 years. So price told us for those 6 years, it was really, really struggling to figure out its business model, how to make money. And then obviously in mid 2019, it took off. But the price chart itself only tells us what is actually happening, not what we want to have happen, but what is happening. Okay, thank you for that, Viswana. Next one is by Matthew. What are your thoughts on Bitcoin as an investment? Do you mess with cryptocurrencies at all? So I personally don't own any Bitcoin or any of the other cryptocurrencies. I had this right here. This is the Bitcoin index. It only goes back to 2015. But what I do is I study price, and I pray to the altar of price. I'm a lifetime student of price. And so what I'm ultimately buying and what I train my students to do is to buy price, to look at price, to let price tell us what to do, and not our feelings or our gut or our sadness or our madness or our gladness, but to study price and look to price for the answers. And so as far as this, what I see based on price is huge run up, about 80x from the bottom of that chart up to the top of it. 80x is amazing. And it's really just consolidating right now. Obviously, this could be very bullish if it breaks to the upside. But this consolidation, depending on where you want to do it, is pretty wide. And these corrections here, guys, those are huge corrections. I believe that one's an 80% correction. That one's a 60% correction. So there are massive corrections in Bitcoin. So this is not for someone who is faint at heart. But I don't specifically seek out cryptocurrencies. But again, what you want to do is get trained to understand price and be less interested in whether it's a crypto or a bond or a stock or a pot stock, and more about the behavior of the price. Okay, this is from Bill. Hey, RC, I have a lot of respect for your style of investing. However, your comments on people going to cash is contrary to what you teach. You've told us before that cash is a position. Absolutely true. It is a position. It has to be a conscious position. And you don't want to be in cash that long, because history says that the market goes up, the stock market goes up 80% of the time. If you're an older person and want to preserve some of your hard-earned money, then going to cash is a wise position. So that's where I probably disagree. I think one of the best things to do is to get trained and understand where your money is. Because if your money is on a price chart, and let me just pull up just the S&P. Now, you have to get trained to understand what is a correction and what is a crash. But to me, one of the most stable things one can do is put their money on a stable, uptrending, black squiggly line, because that increases your certainty and consistency. The problem is, guys, people are not trained and rewired to think about how to use their money. They're not trained to think in pictures. And it's one thing to hear what I say week after week or year after year. It's another thing to actually go through a training and get your brain rewired with your own money and your own portfolio. So to me, the most stable thing one could do for their money is put it put it in and understand how it works in a stable uptrend. Now, let me finish that question, Bill. My only other comment is that getting back into equities could have been done quicker by many people, as they have missed a great run-up. So being scared as an emotion can help preserve capital. So that I actually completely disagree. The market doesn't care about our feelings, the market doesn't care whether we're scared or mad or sad or glad. And what I've noticed over the last 22 years of training adult humans and their brains is our emotions get us into trouble. And it doesn't actually preserve our capital because there's something called inflation. And especially if you have inflation around education or healthcare, or you live in any part of the country where inflation is above 2%, which basically is the coasts, the best way to preserve capital is to understand how to grow it, both grow that capital and the income that comes from it. And that, again, gets back to really being trained on how to get your money on those uptrending black squiggly lines. And you say, but also knowing where the money is flowing into and when is equally as important. I agree. Money always has to flow into somewhere. And again, going to cash is fine if it's based on a checklist, if it's based on a strategy, if it's based on the market telling you to get into cash, not your gut, not a sleepless night. And the thing is, people have been taught to focus on themselves. And I think that's a problem. Yes, it's your money. You have to understand how much you need, what your monthly bills are, expenses, of course, and that's just part of it. Okay, next one, this is from Dave. In the Berkshire S&P chart, which is indeed hard to read, assuming that the y-axis is performance, your return, it appears that Berkshire has outperformed the S&P for all of those years because the red line is above the blue line. What am I missing? So great question. So if you look at this screen here, the red line is Berkshire and the blue line is the S&P 500 with dividends reinvested. Berkshire has no dividends, but even if they did, it would be reflected. So what I want you to do is focus on how the race ends. So this race is 500 days. It was just the default. So there's about 220 trading days in a year. So let's just call this 2.5, 3 years. So in this time range, and it actually almost doesn't matter. We can start at the 220. So it's like a 1 year time range. But what I want you to focus on is how the race ends right here, right? And what you're going to notice over the last 19 years or so. Is this a question to me, sweetie? Okay, thanks. What you're going to notice is Berkshire, the red line, ends below the blue line almost every time I scroll back for almost 2 decades. I think we go back to 01 where the red line starts hanging out above the blue line. So you want to see where it ends. And so I'm just going to scroll back into, I'm not going to stop every year, but we're now going back in time. Now we're back to about a 3-year time frame, still red line still below. And I mean where it ends. You want to see where it ends. It's still ending below. I'm just changing it now. We're going from 1 year, 2, 3, 4, 5, 6. This is 7 years. This is 8 years. This is 9 years. This is 10 years, 11, 12, 13, 14, 15, 16. Oops, it's getting away from me. 16, 17, 18, 19. No, we're not at 19 yet. 19, and now it pops above just at 19. So really anytime over the last 18 years, Berkshire has underperformed the S&P 500 with dividends reinvested. And that's a pretty big deal because I really do believe, I'm recording this on Thursday, not that his birthday was yesterday or today, but I believe Warren Buffett is about 89 years old. And he probably should have stopped playing about at 70 and taken his 50 or $100 billion and started giving it away. But he didn't adapt with time. Okay, this question is from Nick. Hey, Nick. Hey, RC, are you suggesting that going to cash now due to fear what's to come is a mistake, as it apparently was back in 2016? Aren't these quite unique circumstances and not comparable to other historic events? I just hear the dog waking up over there. We'll see how this goes. That's correct. I think going to cash out of an emotion is a mistake. I'm just going to my kind of standard view is a 3.5 year view. And we have to be students of price. Let me just make this, I want to make this screen bigger so we have more real estate here. We have to be a student of price. And whether it's the S&P or the NASDAQ, NASDAQ's a clear example. me get rid of this Zoom thumbnail. We don't need this in here either, guys. We have to be a student of price. And I often take price and I price it in different assets, sometimes in bonds, sometimes in other indexes. And so it's okay to be scared. It's okay to be sad. It's okay to be mad. It's okay to be glad. But you don't want those feelings determining your portfolio. You want the stock market and stock price charts to be determining what you do. And that's easy to say, it's easy to hear, but until you actually get trained and with your own money and your own brain gets rewired with the training, it's hard to know how to implement that. But to answer your question, that is absolutely true. You guys want to quickly see the puppy? Should we show them the puppy quickly? All right, guys, here's a puppy. Here's our little puppy. Hello, sweetie. Oh, hello. Oh, okay. This is Scotchy, as you guys know. He is teething. He lost 2 teeth this week, and he's getting bigger. The paws are getting so big. Yes. Oh, there goes the teething. Okay, thanks, sweetie. Oh, there we go. That was a little puppy break. Okay, Emil, I love your updates. While I frankly have recovered and moved above my highs from earlier this year, I remain concerned about the potential for a more normal end of the 10-year plus bull market. Is it correct to assume the COVID-driven drop is the end, especially given the bounce back, or is a more significant and prolonged reckoning coming? Question in context of cycles. So, fair question. Let me get to the S&P. I believe what we have here is a combination of 1987, both the 1987 drop, which was a drop we could not have predicted and could not have managed. This drop you see right here on the screen is 34% in 1 month. What 1987 was, what it really was a 23% drop in 1 day. Gulp. But overall, it was a 33% drop in 3 months. So extreme drops like that has the same effect of, say, a 50% drop over 18 months. So this absolutely scared the heck out of people. And guys, price is never wrong. Yes, price can go up or down, but price is never wrong. The market is never wrong. We and our emotions and our guts and how we think and feel can often get us into trouble. So when you have the Fed expanding their balance sheet by 2.5 trillion in 25 days, 2.5 weeks, 2 days, 2 minutes, and saying we're ready to expand as much as we need to, guys, that's going to move into the market. It's going to help the top 2%. I'm not saying it's right or it's fair or it's justified, but that's what we have. And so all we have is the market. I will say to you, the fact that the Qs are going higher, and the Qs are the 100 largest companies in the NASDAQ composite. That was leading into this correction or crash, whatever you want to call it. It's also leading out. Tech is also leading out. Gold is also leading out. It's okay to have gold go higher and stocks go higher. So we have to. You want to get trained to understand what price is telling you so you can sleep well at night. Plus, I don't think this is a 10-year bull run. I think people often, and I'm not saying you, Emil, are confused, but you got to be consistent with what your bull markets are. So most people consider the biggest bull market ever 1982 to 2000. The thing is, that was not the market bottom like 09 to today, which is 11 years. If you don't want to call it 11 years now because of this 34% fall, that's fine. But this market broke out to new lifetime highs in 2013, not 2009. So that means this bull market is 7 years old. And this 34% correction in 30 days, 1 month. Yes, maybe put an end to that technically, but these are just terms humans use. We could absolutely move higher. The Fed could print money. And what's the competition here right now to stocks? Bonds? No, their bonds around the world are between negative and maybe 1%. So bonds are not creating that place of capital growth anymore. So you have this major asset class that's off the table. And then currencies are underperforming to gold for the last, depending on what currency you're in, for 3 to 5 years. So we don't have many major assets to move into. Gold is a sub asset. And then Emil again, does the rise of precious metals foretell a plateau in stocks? as I thought you say once upon a time when you describe long-term cycles? And the answer is no, it doesn't. You can have stocks go up and you can have gold go up at the same time. In fact, sorry for my screen moving so much, guys. Got to move around a lot. The old single dadhood with the kids and now the puppy. But let me zoom out here just 20 years, update that, show you that. And then also let me just throw gold down here and we can just compare that to gold. And you can just see that sometimes stocks go up. Gold bottomed about here. The top price chart, oops, it was supposed to be the top price chart. Okay, so here at the bottom is gold, the top, as this is not working for me. Hold on, technical error, not working how I want it to work. Here we go, finally. The top price chart is stock, the bottom is gold. Here's an example where they both went up. Here's an example where they both went up. Here's an example where they both went up, right? Here's an example where stocks went up, gold went down. Here's an example where stocks went down, gold went up. Here's an example where stocks went down and gold went up. So there is no correlation between them. Sometimes they go up together, sometimes they don't go up together. Okay, this is from Nicholas. Interesting video. I think that comparing the current market to previous markets in terms of length of bull markets is not that helpful. The truth is no one knows. Completely agree. No one knows. But it's fun to look at past bull markets and talk about what the beginning of the bull market is and not. The one certainty so far is that equity markets over time have always ended up increasing in nominal value. Okay, this is a combination of growth in the economies of the countries, the world, amount of money pumped, okay, blah, 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 central banks, governments. Today, the growth of the market is driven by central banks. Okay, no fight there. Government stimulus, how long will that continue? No one knows, and saying there could be another bull market for 10 more years is meaningless. Yeah, so I disagree, because what happens is people think, oh no, it has to end, or it's over, or it's done, or we're going to have 10 years. And I'm simply pointing out, we don't know. And if you go from past bull markets, and that's all we have is the past. And I looked at, I believe in that video, 50 years, or the last half century. The last half century is a pretty long period of time. To simply point out that we define a bull market when it starts and breaks out to new lifetime highs. And if we apply that here, the S&P is in a 7-year bull market. The NASDAQ's in a, totally going from memory here, 5-year bull market. Simply pointing out that from 82 to 2000 was the 18-year bull market. So we could see easily another 10 years of this going up. And then you say, what would be more helpful is working out the best investment with the particular set of circumstances that we have at present. Well, that's what I do in my training, and that's what I train people to do. We don't take positions. We are not attached to what we own. We'll have a bias to it. But one of the things that I do is train people to not care, or to do their best to not care what they're in, but to know that they're in an uptrending stock. That is something that is trained. And that's a problem with these free videos, guys. This is not me training you. This is me giving you a little teeny bit or bite. And to extrapolate a whole training program out of this is dangerous. Let's see, we got in those early earning years as against those in retirement years, as to say years, and say just by relative strength, irrespective of any relationship to fundamental value, is also dangerous. I completely agree with you. I completely disagree with you. I don't follow fundamental value. I don't even know what fundamental value means anymore. What does value mean relative to what? Right? When you have the largest central banks on the planet, all of them expanding their balance sheet, and you have a 10-year treasury yielding negative 1% to maybe 0.5%, value to what? Fundamental to what? And it's dangerous to go back to ideas from the 70s and the 80s where, say, maybe a 10-year was yielding 10 or 7 or 5%, and today it's yielding negative if you adjust it for inflation. I believe fundamental information is very invaluable at best and dangerous at worst. And I believe what's most important is price. And price knows what the 10-year treasury yield is. Price knows what gold is doing. Price knows what, in this case, Powell is doing. Price knows who is in the White House. Would you really buy Tesla at this point? Anyone can always add in would you really go short Bitcoin? Would you really, guys, there's like 12,000 stocks in the US. There's probably 100,000 stocks all over the world. So this is a way of creating a debate with, it's like, it feels like you're creating an argument, and I'm not interested in arguing. So when you take what I call first principles, you can always find a case where it's like, yeah, you shouldn't. And I'm not sure how one would extrapolate what I say to, you have to go buy Tesla. I mean, what Tesla's doing, I'm just going to keep gold on there right now. What Tesla's doing is impressive. So I'm not sure how one can go from principles that keeps people's money safe to then kind of being like, would you buy Tesla? I personally wouldn't buy Tesla. I don't quite understand the company itself. People are pricing it in to basically solve all humanity's problems. So it's kind of odd to take principles. There's always going to be stocks and whatnot that go and act in ways, but it's an individual company. So yeah, hope I answered that. Okay, David. Hi, RC. What are your thoughts on USLV and UGLD? They were both delisted by Credit Suisse, but are still traded under the ticker symbol USLVF and UGLDF. They are both 3X ETNs. They have an amazing history, i.e. losing little value over time in relationship to silver or gold. Can the new ticker symbols just disappear? So look, ETNs can go away. They can return money to the owners. So I'm not an expert on ETFs or ETNs, but these are financial products that are owned by companies. These companies can close them down. I'll show you a price chart. We'll pull up USLVS, USLVF. Yeah, so here it's a 3X silver. It's a 3X silver. And just for fun, let's put silver down here so we can just see how silver has behaved. And I'm going to go auto height. Let's go there. Let's just see, because silver's gone sideways. So one of the most dangerous things about owning leverage is owning leverage when something goes sideways, because it has to get repriced every day. So silver has gone sideways for, let's just say, since mid 2013. So it's today, silver's at 1976. And the last time, farthest back can go, yes, it is middle of July 2013. So let's just say silver's done nothing for 7 years. Now, if we go up here to triple silver, this went from 530. Guys, I need glasses. It went from 530 to 80. So sidewaysness is the death of anything leveraged. You only ever want to own leverage when the underlying asset is clearly in an uptrend. And then these things become very, very magical. But leveraged anything in a sideways market is incredibly dangerous. And this is a great example, because this thing went from, what did I say, 580 to 80, lost 80% of its value, when silver itself just, quote, unquote, just went sideways. So guys, I want you to leave comments, and I want you to tell me what's on your mind. It's best for me to block all these together to see how they're doing. So I can not see how they're doing, but to put them all together so I know best how to answer them all at once. So please keep leaving comments, and I appreciate you guys in my world, and I will speak to you guys soon. Okay, thanks.